Welcome to the Deep Dive. Today we're unpacking the Q3 2025 earnings call for Cango Inc. And this is one of the most radical business transformations we've seen in a while.
It really is. I mean, they've pivoted completely away from their old business in China auto finance to become a global digital asset miner.
And now it seems an aspiring AI compute utility.
Exactly. So the results dropped after market close on December 1st, and the call itself was pretty fascinating. It showcased huge operational scale, but also just massive ambition.
Right, and that's the core mission for this deep dive. We need to understand this dichotomy. How did Cango deliver a massive GAAP EPS beat, and yet the stock sells off? It dropped nearly 10% right after.
It's the classic Wall Street puzzle, right? The headline numbers versus the story in the balance sheet. And with Cango, you have to throw out all the old models. They just don't apply anymore.
So it's all about context. Let's start with that big win then, the headline beat.
Okay, so the big win was profitability, no question. Cango reported GAAP EPS of 19 cents.
19 cents. And the street was expecting what?
A loss. A loss of 20 cents. So that's not just a beat. It's a nearly 200% positive surprise. I mean, if you were only looking at that one number, you'd think the stock would be flying.
But it wasn't. And that's because we have to look at the revenue line, which is where all the noise started.
Exactly. Total revenue came in at $224.6 million. Now, in isolation, the good news is that's up 60.6% from last quarter.
Which is fantastic sequential growth.
It is. But here's the confusion. The legacy consensus, the old models, were still looking for something like $1.15 billion. So against that number, it was an 80% miss.
So you're saying the miss wasn't really a miss on the current business. It was just analysts using outdated models from the old company.
Precisely. It was a failure of the models to adjust, not a failure of the mining operation. So you've got this misleading headline, but underneath, you have massive growth and that huge EPS beat.
So what about cash flow? Did the profitability show up there?
Oh, absolutely. This is what validates the pivot. Adjusted EBITDA surged to $80.1 million.
And what was it a year ago?
Barely $1.2 million. So yeah, the new mining operation is undeniably generating a ton of cash.
Okay, so let's unpack that new engine. Let's dive into the core mining economics, because this is where the market really got stuck.
Right. This is where the skepticism comes in. The revenue mix is, it's about as pure play as you can get. Bitcoin mining was $220.9 million. That's what, 98% of their total revenue?
And the rest?
A tiny sliver. Their international auto trading platform, Cango, brought in about $3.3 million. They did point out that it grew 90% quarter over quarter, so they haven't totally abandoned it, but yeah, it's a rounding error.
The main event is Bitcoin. How big is the scale we're talking about here?
We're talking global leader scale. In Q3 alone, they mined 1,930.8 BTC.
Wow. So that's over 21 Bitcoins a day?
Every single day. It's a 37.5% sequential increase. And they've hit a deployed hash rate of 50 exahash per second. That puts them right up there with the biggest names in the industry.
Okay, but here's where that success story hits a wall. The cost. This is the number that I think shocked everyone on the call. What was their all-in production cost?
This is the number. This is the whole reason for the sell-off. Their average all-in cost per Bitcoin mined was reported at $99,383.
$99,000. Wait a minute. Just to give you some context, the best-in-class operators are often below $50,000.
Yeah.
Some are even closer to $45,000. Why is Cango's number almost double?
That is the multi-million-dollar question, isn't it? That 99K figure means their margins are razor thin, or even negative if Bitcoin has a bad week. It's usually a mix of things: higher energy costs, inefficiencies from scaling up so fast, and just the overhead of managing a global footprint.
So it underscores a massive volatility risk. If Bitcoin is trading below 100,000, they're barely making money.
Or not at all, after all expenses. And speaking of efficiency, management had to explain the gap between their deployed and operating hash rate. They have 50 EHs deployed, but only averaged about 44.9.
What was the reason for that?
They were pretty upfront about it, said it was temporary downtime from moving machines between states and also commissioning power at some new sites. These things caused disruptions.
And what's the situation now?
They stressed that uptime has stabilized now above 90%. They tried to frame that as industry leading, but,
90% is solid, but the market wants to see 95% plus from the big players. So huge gross, but a big efficiency problem to solve.
Exactly. And that efficiency challenge leads us right to the balance sheet, because if your margins are thin, your capital structure has to be perfect. And Cangos is, well, it's complicated.
How so?
Well, for one, their cash position is pretty small for a company this size, just $44.9 million as of September 30th.
Which seems low given their operational needs. You said it was complicated, though. I'm guessing it's the debt structure.
It's the debt and the receivables, and specifically the related party dynamics. This is what really raises red flags for investors.
Okay, break that down for us. What are we looking at?
Two huge numbers. First, they hold a non-current receivable of $660 million, which is related to BTC collateral. Second, they owe $405 million in long-term debt to a related party.
Why does that make institutional investors so nervous?
Because related party deals aren't arm's length. Investors worry about transparency. Are the terms on that $400 million loan fair? And then that $660 million receivable, it's collateralized by Bitcoin. So you are tying your balance sheet stability directly to BTC's price.
And they're holding all the Bitcoin they mine, right? The mine and hold strategy.
They're sticking to it, yes. Which makes their entire financial profile this massive leveraged bet on the price of Bitcoin staying well above their production costs.
It's a high-stakes game. Did they talk about optimizing this structure at all?
They did. They mentioned converting some short-term debt to long-term to better align with their strategy. And they said borrowing costs are stable around a pretty favorable 7 to 8%. But yes, they confirmed they are holding all mined BTC. No selling.
So massive leverage, expensive mining, all betting on Bitcoin's long-term appreciation. This has to be where their grand strategic vision comes in. They basically use this call to say, Bitcoin mining isn't the end goal.
Not at all. They position it as an on-ramp to a much, much broader energy and AI compute strategy.
So they're saying, we built this energy infrastructure for mining, now we're going to use it for AI.
That's the pitch, exactly. And they laid out a very clear multi-phase roadmap for it.
Okay, let's go through it. Phase one.
Phase one is near term. Launching GPU compute leasing. They called it an asset-light connectivity layer. So basically brokering GPU capacity they have access to. It's a quick way to get into the market.
Get some non-mining revenue on the books. Okay, what about the medium term, phase two?
That's when it gets more capital intensive. Building their own regional AI compute hubs. So self-operated data centers tied to that energy they've secured. The focus here would be on selling low-latency inference services.
And phase three is the ultimate vision.
The ultimate vision, evolving into a global green energy AI compute grid. They want to be an infrastructure utility, selling long-duration capacity contracts. To prove it, they pointed to pilot projects in Oman and Indonesia.
But they also bought a facility in Georgia in the U.S. That doesn't sound very asset-light.
Right, and they addressed that. Management said the Georgia site was a strategic upgrade, a necessary move to get low-cost, stable power, which you absolutely need for AI data centers. They said future expansion will be a mixed lease first, but buy when it makes strategic sense.
So we have this incredible Q3 performance, $80 million in adjusted EBITDA, but this very ambitious, very expensive long-term AI vision. Yeah. The market just rejected it. The shares sell off almost 10%.
And that is the core divergence. Management is pitching you the AI utility of 2027. The market is pricing them as the high-cost, high-beta Bitcoin miner of today.
And the stock performance shows that. Cango is down 35, maybe 45% over the last year, while similar Chinese tech peers are actually up.
The market skepticism really boils down to two huge risks. First, and we keep coming back to it, that all-in cost of almost $100,000 per Bitcoin. It just kills their financial flexibility.
And the second risk is the AI plan itself.
It is. It's the execution risk and the sheer amount of capital needed for those pilots in Oman and Indonesia. You're talking a 1 to 2 year timeline before you see any real revenue from that. The market hates waiting that long, especially when the core business is on such thin ice.
Management did try to get ahead of this, didn't they? They addressed the whole AI bubble concern directly in the Q&A.
They did. They argued their approach is different. It's a lighter asset structure, it's edge-oriented, and they have strict IRR hurdles for projects. But right now, that's just talk. The market wants to see signed contracts, not just pilot programs.
This is the deep dive, and we always need to stress that this next segment is absolutely not financial advice.
It's purely a thought exercise. It's based on the really clear divergence we've just laid out between the company's vision and how the market is actually valuing them today.
So given that dichotomy, the high-cost miner with a huge capital-intensive AI dream, we can sort of construct a plausible trade idea based on how the market might behave.
You have to ask yourself which narrative wins out over the next, say, 6 to 9 months. The AI utility of the future or the high-cost miner of right now?
And the most plausible answer is that the market will continue to price Cango on its core mining economics. It's not going to give them full credit for an unproven AI story, not yet. That nearly $100,000 all-in cost is a massive anchor.
So the bearish thesis is basically a bet on near-term multiple compression. It's a bet that as the execution risks around those 1 to 2 year AI projects become clearer, the market will get impatient.
It's a bet that the market will demand proof real revenue, real contracts, before it assigns a fancy tech utility valuation. Until then, the high cost and the complex balance sheet are going to weigh on the stock.
Exactly. It's a bet that the cost of mining today will trump the promise of AI tomorrow, at least for the foreseeable future.
So to recap, Cango delivered a really strong Q3 operationally. That $80 million in adjusted EBITDA is real. The scale up to 50 EHs is real. The revenue miss was a red herring.
And it's a huge bet. The complexity of that balance sheet with the related party debt and that big BTC receivable, combined with the really long timeline for AI monetization, has led the market to just punish the stock for execution risk.
And the fundamental question for you as you think about this company remains pretty simple.
Can Cango actually fund its expensive AI dream while also fixing the profitability of its high-cost mining base? That tension between the costs of today and the ambition for tomorrow is what will define this stock for the next year.
Thank you for tuning into this deep dive. They'll catch you on the next one.